you look at the intraday chart, this is what it means when you can maybe see liquidity on the chart. This looks like Braille. This looks like if I close my eyes and start putting my hands over the screen trying to read the little ticks, right? This isn't really tradable. This to me isn't tradable at all. What is going on, traders of YouTube? Welcome back to the channel. I'm feeling a bit inspired today to make this video because I want to talk about liquidity and volume, okay? You've probably heard your most favorite guru, your favorite trader online say something, or even us at Clover, right? Say something along the lines of, you know, this stock's really good, but needs more volume. Or I like to trade this stock a lot because it has volume. I need more liquidity in this thing to feel comfortable trading it, right? What does that like actually mean, right? It's one thing to hear the word, but then to actually really understand it in the marketplace when you see it and use that to your advantage. So in this video, we're going to talk about the differences in both and why ultimately both are important to really understand how to use them well to your advantage in the world of trading. So without further ado, like and subscribe and let's jump right in. So let's compare the two. Let's know the difference between the two when you say liquidity and volume, because a beginner could have just take the lazy approach and assume both are the same, but they are not. And I'll show you why. Let's go over the technical definitions first. Volume is just the amount of shares a stock is traded on the day. Okay. Now, the reason why you need to know that definition is because when you compare and contrast it to liquidity, that's when things change. Liquidity is how much volume can actually go through and trade on a stock, right? And that's not the true technical term, right? But that's how I interpret it, and that's how it's used, right? It's how much volume is actually being transacted between people, between traders, right? So it's not just enough to have volume, it's how much times is the volume being traded, because again, you can find some XYZ ticker that has 10 million shares traded on the day. But if it's literally just one transaction where one person bought 10 million shares and one person sold 10 million shares and there was no other trading all throughout the day, that ticker would be pretty illiquid. Right, you would try to trade it and not be able to fill anything, but the big Joe Schmo who's buying 10 million shares and the bigger seller who's selling 10 million shares, they're fine, they're happy, they've made their transaction, but you aren't making any transactions. There's no volume or liquidity for you to be trading it, and so that's why it would be considered illiquid. Even though it has a ton of volume, 10 million shares, the liquidity isn't there. It's very similar to, you can almost compare it to like the housing market, right? There's tons of volume in terms of houses being bought and sold every day, but how frequently they get bought and sold, right? It's the illiquid part. You can't access it quickly. It takes months for you to sell a home, and in the stock market, especially when you're day trading, you want to make sure you can buy and sell something within the second, within the microsecond, really, right? And so that's the key difference, right? You want to trade stocks that not just have volume, but are transacting that volume hundreds, if not thousands of times, a minute. And so a perfect example of this, seeing and contrasting the two, is a good example of RGC here. Now, RGC, I'm bringing it up because it is pretty much like a black swan. This thing has gone from 30 bucks to now hit a high of like 900 on Friday and today, which is insane, right? Most tickers do not have a run like this. And normally I would say there could be some legitimacy behind this run if there was a ton of volume. And what I mean by that is, like, if there was a ton of traders trading it, then maybe it has a cool like story behind the business or the company. Maybe there's some kind of hot trend with it. But if you look at the volume, you look at the chart, there's almost none. In fact, because there was so much volume that traded back in March, 20-something million shares on March 13th, it almost makes the chart look kind of distorted where there's shows no volume at all. But yet today it's been trading 16,000 shares. So yes, it's trading volume, and sure, 16,000 shares in the $700+ range. Sure, I'm sure there's a lot of money trading it or going in and out of it. But again, you look at the intraday chart, this is what it means when you can maybe see liquidity on the chart. This looks like Braille. This looks like if I close my eyes and start putting my hands over the screen trying to read the little ticks, right? This isn't really tradable. This to me isn't tradable at all. And every little tick here is a transaction. So, I mean, gosh, this went off at what, 750? This went off at 777. It's like the spread, the liquidity, it is awful. Okay. But again, to someone who just looks at the volume and does the math of, oh, well, it's trading 16,000 shares at $800. Let's just do the quick math. That's $12 million, $13 million. Now, again, and that's not that much dollar volume, right? And a lot of tickers we like to trade to have hundreds of millions of dollars in dollar volume. But someone could argue, oh, well, $13 million have flowed through this stock. Technically, it's tradable. Not if you look at the details, right? Not if you get into the actual granularity of it all and realize, hey, this isn't something I can actually be in and feel comfortable. Right? Especially from just a slippage standpoint, right? If you bought 777, the next best, bid at the time was 750. That's not something liquid. That's not something that makes you feel safe. Okay. Now, let's compare it to something different. Let's compare it to one of the most liquid tickers in the market, MSTR.
Ever dreamed of trading like one of the Clovers? Well, it all starts with choosing the right broker. Clover Trading and Cobra have teamed up to supercharge your trading experience. By clicking below, you'll unlock the power of Cobra Prime. We're talking top-tier trading tools, saving you hundreds of dollars. Get ahead with real-time scanners, cutting-edge news, 30 days of commission-free trading, 30 days of free DAS software, 60 days free of Ask Edgar, and so much more. Imagine all that, plus superior short inventory, personalized support, and interest on your idle funds. But it doesn't stop there. Cobra offers competitive pricing on locates and commissions that fit your trading style, with the ability to trade stocks, futures, options, and other products. If you're under the pattern day trading rule, Cobra has a unique solution for you. Venom, a platform designed for traders with smaller accounts to go long or short on small and mid-cap stocks. Ready to elevate your trading game and save big? Click the link below to access exclusive deals only available through Clover Trading and Cobra.
This thing has had a big run similar to RGC, right? Maybe not as crazy, but again, over the last few years, this has gone from 40 to, as high as 550 at its peak. Right, so not 900, but it's a much shorter time frame, but it has made this significant kind of move. But again, look at the volume. It's trading a minimum of 12 million shares a day. And again, we're talking in the $300 range. Let's just compare and contrast that on the dollar volume level. That's $4.2 billion of volume. So way, way different. And on top of the fact, then you go into an intraday chart, there's no braille, right? There's maybe a little bit of braille pre-market because again, most people don't trade pre-market. But once the market opens, there's not a single candle here where you're in danger of hitting a massive spread, right? There's going to be any transaction you have is going to be fairly within a dollar of itself, and you're going to be fairly safe to get in and out with any size you have, right? Even some big institutions who have to trade hundreds of millions of shares or dollars, you feel pretty safe getting in and out of something like this. They would not feel safe in RGC. They would be terrified because it would take them a very long time to get in and out. Now, if you're a real trader like you and I, most of the time it doesn't matter because you and I are only trading a couple thousand to maybe a few thousand shares. But where it gets granular and important for you to know this is one, why, because again, we know the difference now, we've covered that, but why is it important? Why is volume important? Well, it's to know if you're going to be feeling safe. Liquidity is also feeling safe, but when we talk about specifically volume, there were a ton of tickers, and it's escaping me on some of these examples because they've been so far and few between, but 2018, 2019, Kyle, when I only had a 20, 50K account, where I was just kind of starting to grow my profitability and growing my account, but still a fairly small one, right? Any account under 6 figures is fairly small in terms of the grand scheme of trying to day trade for a living, right? There were all these tickers that had enough volume for me to trade, but realistically now, 2025, Kyle, I would not trade them. Why? Because my size has grown, my accounts are bigger, and now I can't trade them, right? A very safe general rule is you don't want to be more than 1% of the volume of the day, right? So if MSTR here is going to trade 12 or 10 million shares in the day, I don't want to be more than 10,000 shares of that, right? That's 1% roughly. That's less than 1%. I think that's 0.01%. And again, 10,000 shares is almost 400 grand for me. I rarely take a $400,000 position on certain stocks. So that's the scale at which how comfortable I could feel in something like MSTR from a volume and liquidity basis. But again, if you trade RGC, it's okay, this thing's trading 16,000 shares or 70,000 shares. 1% of that is 170 shares? Again, the volume is lower, but again, 170 shares, even with a spread that we've talked about, I'm going to be risking thousands of dollars just from the sheer fact of being in the trade. Not even if I'm at a risk level, but just for the sheer fact of I want to buy and sell with the spread this has, it's already risk on the table, right? Now, another thing I want to mention of the importance of volume specifically is how well will your pattern or setup work? Right? And there's a ton of times, and ultimately beyond me becoming bigger size in terms of the volume conversation, another reason why now 2025 Kyle wouldn't trade what 2018 or 2019 Kyle would trade is because I want patterns to actually work, right? I want patterns to be in my favor, the odds to be in my favor. And I can't tell you how many times there'll be two runners, right? There'll be a runner ABC that's gone up from $1 to $3 and runner XYZ that's gone up from $1 to $3. Both can look identical in terms of technical setup, but one could have all the volume in the world, be insane, a ton of volume, a ton of liquidity, more than you could ever need. And another will be just as liquid as RGC here, okay? I almost promise you I will trade the more volume traded one 10 times out of 10 and never the liquidity one, not solely because of the volume and liquidity, but because the patterns or the setup that I'm looking to trade it as, which usually would be a first red day. Again, if I'm looking at an overextended stock and looking for the first red day backside move, we talk about that a ton at Clover Trading, right? That's my favorite setup. Typically, a first red day is more likely to happen if there is volume present. If there is no volume present, well, who's to sell? Or the whole point of a first red day setup, and not to go off topic with a setup here, but the whole point is that it's the first red day, meaning if there's a ton of long bias traders selling their stock off and locking in profits after being up 100, 200, 300% over the last couple of days. If there's no volume, then there's no one to sell. And if there's no one to sell, then the stock doesn't go down. Hence, the short setup that is in front of me here doesn't actually work. Or even worse, and this happened to me a ton of times, it will work and then come back on you. It will look like the setup is working because a few dozen people sold their shares, so it did go down. But then all of a sudden, there's no continued sellers and there's only buyers, and the stock comes right back up. And again, that will ruin the edge. Right? If I'm only trading in liquid first red days as a setup, it's going to be much, much different than if I'm trading a liquid first red day setup, okay? And now the importance of liquidity, right? We just talked about a little bit of the volume, but the importance of liquidity I want to talk about is specifically in a ticker today, INM. And what I mean by that is there are sometimes certain tickers or companies where they're only going to be in play when there is volume, right? This particular company has been dilutive in the past. Clearly by the chart, it is something that is not going up by any means. In fact, it's the perfect top right to bottom left. You can't even see the chart if you scroll back high enough. I've done many reverse splits, right? But the reason why I'm bringing it up here is because their stock does die slowly. But if you look at when there's ever actually some serious volume, the stock gets crushed. And why is that? Well, one, they're able to prop it up on a gap up, whether through news or just a liquid pre-market trading. But once the market actually opens and there's volume and liquidity to sell into, again, it's likely a PR. PR kind of grabs eyes, grabs attention, grabs an audience, right? For patterns to work better than they normally would if there wasn't volume like we talked about. But again, this company takes advantage of that, right? The moment there's enough volume, or just any volume at all in comparison to any of these days, there's practically none, and then every so often, every few months, they get a ton of volume, they use that volume to their advantage. That's when they use their dilution to sell their shares into, right? You could have a stock that trades at $1 all year long and it trades no volume. But if you want to dilute your stock, or if you're a company that needs cash and has to sell shares, if you were to sell shares on a company that has no volume, you're going to crush your stock from $1 to say 50 cents. But if you wait for there's a ton of volume, kind of like INM is today, where it's going to trade 60 million shares at between $4 and $7, you can now sell your shares into the open market to all of that liquidity and not crush your stock as much. Does that make sense? Because even now, it's still up. What is this up? Probably 60-something% on the day, right? It was up much higher, but again, they probably sold shares into their stock price to get cash and stay alive, etc. Had they done this with no volume, like I said, this would have gone from 250 probably to like 150. They would have crushed it. They strategically wait for when there's actual volume and liquidity come into place, and then they use that to their advantage. Again, as a trader, it's important to know those things, not only to avoid, the dilution risk of certain tickers, but to know the games that can be played, that during when no volume periods, stocks can do whatever they want because they're just super liquid. But once volume comes into play, there are sometimes an agenda behind some of these companies, and you want to make sure you're aware of that and use that to your advantage. Now, there are other important things like blow-off volume exhaustion, right? Or volume disappears. So a perfect example of this is like EDBL. This was last week's runner. EDBL, again, a ton of volume, right? 90 million and then 110 million. But the next red day dropped to 2.5. Now, 2.5 million is technically enough, right? And I could say so because I technically was short from this day into this day and I covered my shares. So there was enough liquidity to get in or out. But this is something, again, more nuances of volume and liquidity they look at. It's like, well, why did it go from 100 million shares being traded down to 2? We're talking a massive drop off. And so although this red day worked, it's back to that example I said of like, there might not be enough sellers. Now again, 2.5 million is enough sellers for the red day to work, but I've seen tickers before. Well, again, they'll be trading 50 to 100 million shares, and the next day they drop to like sub a million. It's a huge red flag for me. I want all days of the stock being in play to have at least enough volume. Now, granted, on first red days, volume can typically be and usually be lower, but again, I look for not too much lower, right? 2.5 is definitely a red flag for me. I would have expected this to have like 10, 20 mil, right? Lower than 100, but not significantly lower, right? We're not talking 99% lower, maybe like 50, 60, 70% lower. But again, that's just many nuances, right? There's also, again, like I said, volume exhaustion, liquidity traps, right? You've heard that term a lot, stuff like that. So again, there's a bunch of other nuances that could be much, much longer than the scope of this video. But again, that's what we have Clover Trading for you guys to feel free to join webinars, get access to that really, really detailed information beyond just the overall general scope of volume and liquidity like we covered in this video. So anyways, guys, thanks so much for watching. Hopefully you guys learned the difference between volume and liquidity. I know most people don't. And so it's very important to know, like I've I've talked about. Thanks so much for watching the video, and we'll catch you guys next time. Bye.